Last session, 13.4, I want to pick up on a slide that we sort of zoomed through last time. It was a slide that talked about some extra expenses on top of the mortgage and which the mortgage was the premium that goes towards the actual cost of the house and the interest that goes towards the lending institution. This is the last slide we were on last time. There's property taxes, homeowners insurance, and maintenance. We talked a little bit about property taxes. I feel like that one we kind of talked about and as much as I was intending to. I want to talk a little bit more about homeowners insurance. We mentioned last time on the homeowners insurance that it covers this thing called liability as well, which covers you in case somebody were to sue you if they got hurt on your property. The thing I wanted to talk about is that there's a component of homeowners insurance. It's the component that we typically don't consider when we rent, and we should. There's something called renter's insurance, and it's actually technically a homeowner's policy, but you don't own the home you rent. And what that actually covers is it covers your things inside of your dwelling. So if you had renter's insurance and you had your own apartment, what it would cover is if the apartment burned down, blew away in a tornado, had huge flooding issues or whatever, what would happen is that the homeowner's policy that you have as a renter would pay for your things inside. And if you don't have one of those policies and one of these catastrophic events were to happen, the landlord would have coverage for the dwelling, but they would not cover any of your property inside the home. The reason I mention this is because we had a friend at our church who her home was one of the home she was living in was owned by someone else, was damaged in the fires that happened about a year ago. There were fires that swept through Oklahoma last summer, I think it was. And her property, her home where she was living, was one of those homes. And she didn't have any renter's insurance. And actually, the people who owned the home didn't have homeowner's insurance either. But even if they had, it wouldn't have covered her items inside the home. And so everything that she wasn't able to grab, she was able to grab her dogs and a few of her wedding things because she was in the process of planning a wedding. But everything that she didn't grab was gone, and she had no way to replace it aside from the generosity of other people in the church. And people were generous, but she lost a lot of things. And the thing I wanted to emphasize about this is that renter's insurance is cheap. I mean, like dirt cheap. I remember the first time we had a renter's policy. I was in my first apartment and got a renter's policy, and I attached it to the car policy because I had a vehicle too. So I had a car and I had my homeowner's policy. And when they attached my homeowner's policy to my car insurance, it was less expensive than my car insurance by itself had been before. Because you get discounts when you have multiple policies with companies. Sometimes it's one of those discounts. I'm sure you've seen like the Progressive commercials and the Allstate commercials. Like the same thing like with they talk about bundling things together. When you have more than one policy with insurance companies, they will often give you a break on both policies, a little bit of a 10% off or something like that, because you have multiple policies with them. It was actually cheaper for us to pay for both of those policies at the time. Now, presuming that we didn't have a vehicle, I will tell you that the renter's insurance was $13 a month. So even at the $13 a month, if it had been $13 more than my car insurance, that's a steal. Because if something were to happen to all the things in my house, I would not have been financially able to replace the bed and the TV and the couch and all of my clothes and whatever. So keeping that in mind, I wanted to mention that because you guys are in that position in your lives where you're doing a lot of things like renting. And that is something that you can actually purchase, and it's not very expensive, and it's a lot of coverage for what you get. The maintenance, varying by the home due to age. So there's some things I wanted to mention also about maintenance that happen regardless of whether you rent or whether you purchase. Some of your things, like for instance, maybe the washer and dryer, may not be included if you rent. So washer and dryer breaks down, you're the renter, but you own the washer and dryer, then you have to replace the washer and dryer. But there are other pieces of things within your home that if you are not the homeowner, you wouldn't have to fix, right? Roof gets hail damage, you don't have to fix it because it's not really your roof, you're just living there. Once you become the homeowner, now you have to pay to fix it or pay the deductible on your insurance, and then the insurance pays the rest or something like this. So the maintenance can vary a lot. It can vary by the age of the home, right? So if it has a 20-year-old oven, it's going to die. I promise at some point that thing is going to quit on you. So you kind of have to be prepared going into it and looking around and saying, what am I going to need to be replacing in the next 5 to 10 years, and how much is that going to cost me? Because I probably need to keep in my mind that it's going to happen. Something is going to break, and I'm going to have to be out that money. All right, so I'd like to take a look at the situation from Ann and Andy before. Ann and Andy's situation was they were paying almost $600 a month for their mortgage payment, right? $592.88. And that $592.88, of course, part of it was going towards the actual cost of the home, the principal. Part of it was going towards the bank or the lender, but all of it is what they're paying a month. They're paying about $600 a month. But if you consider other issues, namely in particular the taxes and the insurance, their mortgage or their amount that they're paying every month is really not just $600 a month. It's going to include a portion of their amount for the property taxes and a portion of the amount for the insurance. So that's what this particular problem is looking at. It says find the total monthly payment for Ann and Andy if their annual taxes cost $932 and their annual insurance costs $660. Well, you know part of their answer is $592.88 because we are going to be paying that to the bank for the luxury of living in the home that they have actually purchased and we are financing through them, right? Okay. But there's more to it. What else are we going to have to add to this? Okay, so what am I going to write down? What's going to be plus what next, Tyler?
Plus 932 over 12 plus 660 over 12. Okay,
and Tyler said it correctly. Somebody else tell me, why in the world did he write 932 over 12 and 660 over 12?
Because it's not the whole year. You have to divide it with the monthly payment.
Exactly. These were annual costs, right? So since these are the annual costs, that's the cost for the whole year. We're just paying 1 month at a time. So we're going to divide them by 12 to find out what the monthly cost would have been. So let's do this in pieces just so everybody's on the same track. I've got my 592.88 at front. What is 932 divided by 12? Okay, and we rounded to 2 decimals because we're talking about money, right, Tyler? 77.67? All right. And then what is 660 divided by 12? What was it?
55.
55. Even? Wonderful. All right, 55 even. And then we're going to add these three numbers together to find out what their actual amount, and this doesn't include maintenance still, right? But actual amount is that they know for sure they're paying every month. Okay, so when you're really considering what it's going to cost to live in that home, aside from the maintenance if things break down, it's really not $600 a month. It's really $725, because those are the costs that you would have that you would not have if you were renting. You would not have property costs if you were renting. You would not have the insurance, at least at this price, right? Your insurance would be much, much cheaper if you were renting and had renter's insurance. So this is the actual cost that it's costing them to live there. I want to address one other issue that comes up from time to time, and it's probably not something you've had much exposure to, but you may have heard somebody say something like this before, so I want you to be aware of what they're talking about. Some financial advisors will recommend that you should not pay your home off early because you lose a tax write-off. You'll have to pay more in taxes. Okay, we're going to talk about that piece in a minute. We're going to consider whether or not this is good advice within the context of Ann and Andy's situation above. Ann and Andy's loan was a $100,000 loan at 3.75%. Okay, we remember that from before, those numbers? Excellent. All right, so taking a look at that, let me talk to you about what they're talking about. The way that your taxes work is that often at the point when you purchase a home, you're able to itemize your taxes, which means there's some things you can take off of your income and not have to pay taxes on that amount. One of those things is your charitable giving. So if you give to your church, so you give them, $50 a month to your church. We take 50 times 12. That would be $600 a year, right? And you take however much money you make in a year, and you would subtract $600 from it. And so you would not pay the amount of money you make in a year. You pay the amount of money you make in a year minus $600 before they figure your taxes. Okay. So charitable contributions is one of those things. Another one of those things is the interest on your home. All right. So what we're going to take a look at here is first part A. How much would Ann and Andy pay the first year of the loan in interest? And the word says approximately, and the reason it says approximately is because we just did last time this amortization schedule, and we figured out that in reality every month we're paying slightly less than the month before in interest, right? I mean, we understand that that's going down a little bit every month. So I'm going to ignore that little bit every month for the moment and just do a ballpark figure so we can make this calculation and see what it's looking like. Because if we figured it with the amortization schedule, we'd find the same result. It's not going to change the result that we're going to come up with. So I just want to simplify the process for the moment, okay? So let's take a look at this. It wants to know how much interest they would pay on their loan the first year. How do I find interest? You bet. I equals PRT. We've been doing it for 2 weeks now, right? Yeah, this is a formula we're familiar with. You probably don't even need to write it on your card. You know this one. But write it if you need it. Okay. Sorry, so what is P? The principal, which is the $100,000. It's how much they borrowed initially on the loan. Okay, that's the principal. What was the rate? 0.0375. And we're going to do this for a time of 1 year. So we're just going to put the number 1 in here. All right, so I'd like for you to take 100,000 times 0.0375, technically times 1. And what do you get? I think that's what I heard you say, Tyler, was it?
Oh,
Yeah, 3,750. Okay. So the interest approximately, again, this is not exact. It's going to be slightly less than this in reality, right? Like maybe $10 less. Okay, but for the sake of what we're doing here, this will work for what I'm going to show you, all right? We're going to pay approximately $3,750 in interest the first year of the loan. And of course, the second year will be less, and the third year will be less, and so forth. But for the first year of the loan, this is how much we would pay. So what would happen on your on your taxes is that however much money you make in a year, and let's say Ann and Andy make $50,000 a year, just so we can talk about a number. Well, what we would do is we would take that $50,000 they make, and we would subtract the $3,750 from that, and then we would only pay taxes on the remaining after that subtraction. So if you have to have a loan, that's a nice thing, right? It decreases your taxable income. This is a good thing to have, right? So if I have to have the mortgage already, and this is a good thing. But if I'm actually able to pay it off, that's the question we're at. Is if I could just write a check, you know, the rich aunt dies, you're not too sad because you didn't know her really well, but she left you lots of money. Could you pay it off the loan? Should you? I mean, that's the question here, all right? Some people would tell you you should not. So we're going to explore whether or not that should be a good decision to make. So it says, thus the amount of income Ann and Andy pay will be decreased by the amount above. That's what we just said. If Ann and Andy are in a 25% tax bracket, and again, I don't really care what the tax bracket is, I just used this one. We could use any number in here, and we're going to come up with the same conclusion again, so I made one up. If they were in the 25% tax bracket, the question is, how much does this decrease the amount of taxes they pay? Well, previously, when they were renters, that $3,750 that they spent on their interest, they wouldn't have spent on interest, right? They would have had to pay taxes on it just like you would have before. I mean, they would have paid taxes on this. And they would have paid taxes on this at a 25% rate. So 25% is 0.25. So what would 3,750 times 0.25 be? 937.50. Okay. A little over $900, right? So, excellent. We owe the government $937.50 less money than we would have. I mean, that's what that does. That actually decreases how much tax I have to pay. But I want you to watch this. Thus, Ann and Andy are paying the credit union. How much were they paying the credit union? $3,750, $3,750. In order to keep from sending the government how much? $937.50. So they paid the bank almost $4,000 to avoid sending the government $1,000. Was that a good deal? No, it's not a good deal. I don't care what percent we throw in here. If you were in a 10% tax bracket, this would be even worse, actually. If you were in a 40% tax bracket, it still wouldn't be a good deal, right? The percent that we're using, unless that percent were 100% and there's not a 100% tax bracket, okay, this would not be a good trade-off. Again, let me say, if you have to pay it because you don't have the money to pay the thing off, that's one issue. Take the tax break, yay, owe less taxes, right? I'm all about spending less money, sending it to the government. But I'm not going to send more money to my bank so that I can send less money to the government. Okay, are you with me? This is something that's a very, very common misconception. If you ask many homeowners, they will tell you, oh no, I wouldn't want to pay off my home early because I'll lose my tax break. And it simply doesn't make mathematical sense to do that if you're able to pay it off early. Everybody with me? Excellent. All right, I want to show you a couple things more. And the first one is actually something that we haven't talked about yet, but we've sort of talked around it a little bit. It's an escrow account. An escrow account is a reserve account maintained by the mortgage lender Taxes and insurance are collected upfront from the borrower and paid by the lender and the respective agencies. Okay, so we talked about the taxes and insurance just a moment ago, and we found out that it was about $725, not $600 to pay for their home. Well, there's a couple of ways you can do that. As the homeowner, you can choose that the taxes come straight to you and that the amount for your insurance comes straight to you and you pay them. You can make that decision that you will just pay them as they come due. That's one option, okay? And sometimes, of course, like even if you have insurance, you may know this, they may have a monthly plan that you can work out with them too, okay? But you pay them as they come due. The other option is that you can let the bank take care of that. Less for you to worry about, less for you to write checks for, less for you to maintain. The bank can do it. And there's that sort of a nice, easy factor going on there. You're not going to miss the payment. But the downside is, did you notice what it said? How are they done? How are they collected from you? Up front. Which means that when if you decide to do an escrow account that actually pays all this out for you, that you don't maintain it, that the bank does it for you, at closing, you will have to pay a year in advance for your taxes and a year in advance for your insurance. So Ann and Andy at closing, given these numbers that we used earlier, where was it? Given these numbers that they had earlier, they would have had to pay about $1,500 more when they closed on that house, so that there was sitting there in the bank this little pot of money. So that and then every month they pay an additional little bit amount, right, a monthly amount towards that. They still pay their $725, and then whenever the taxes come due, there's enough money in the little pot for them to pay them. Yes?
The people that pay you money at the beginning of the year.
Yes.
Since they're the ones that are now holding your money and paying it, are they getting the interest off your money?
Yes, they
now?
are. Yes, they are. I'll tell you, we have had 4 homes. I've lived in 4 different houses that we've owned, which is a crazy number. I know, I don't look that old. I promise I'm not. We've lived there very short amounts of time. The first 3 houses we did escrow. We escrowed our money out of there. And to be very honest, it was because I didn't understand how escrow worked. I didn't know what it was doing. I just thought, it's simpler, it's easier, why wouldn't I? I didn't understand it. When we got the house that we're in right now, when we purchased that house a little over 2 years ago, I finally had gone through enough financial stuff that I got it and I understood what it meant. And so we don't escrow our stuff anymore. We actually have it set up on a monthly amount that we paid our insurance company, and every year the taxes come due and they're a big chunk of money. And I know in advance it's going to be about this much money in taxes, and so every month when I get paid, I actually have a separate line in my checkbook where I put extra money from our paychecks in every month. Okay, at this point, I feel like I can handle that. I don't know if I could have when I first started out. I really don't know if I would have had the discipline to keep my hands off of that. But at this point, I just know, well, I don't want that huge bill due at the end of the year. That's going to be something I can't handle. So that money goes aside. It's not touched, because if I touch it, I'm going to have problems when the end of the year rolls around. So it's just a matter of preference. It's not a big deal. It's not a different, it is a difference in the amount of like the interest on it, like what you're talking about. But it's not a lot. We're talking dollars only. But the biggest difference is the amount of money up front. This costs them an additional $1,500 up front to do this, right? And when we were doing our house this time, that's exactly what I wanted to avoid. I wanted to avoid that additional upfront cost, because it was going to be a really big chunk of money, because our home has a pretty high property value this time. Our other homes didn't have as high a property value. So we actually have quite a bit in property taxes, and I didn't want to pay and upfront that money so that they could hold on to it for me, which is exactly what you're talking about, and them get to hold on to it instead of me. So it's your choice, but it's something about escrow that's an interesting feature that they have. The other one that we're going to talk about is one other kind of a loan. One kind of a loan, the one we've been talking about, is a fixed rate mortgage. The mortgage rate never changes, right? It was 3.75% this year. It's going to be 3.75% in 10 years. And at the end of the loan, if we were to pay it all off, it's still 3.75%. That's a fixed rate mortgage. There's another kind of mortgage called an adjustable rate mortgage, lovingly called an ARM, right? Or a variable rate mortgage, VRM. What these do is they do not have a fixed rate over time. Generally, they start at a lower amount. So like, for instance, if the going rate for a fixed rate mortgage were 4%, this might start out at 2%. Okay, they start out lower than the fixed rate mortgages. The difference is that they can change over time. And they change over time based on a number of factors. So one of the things that they do is they've got something called an adjustment period. So the adjustment period is the time between rate adjustments. So you might have an ARM that every year it reconfigures. or every 3 years it reconfigures, or every 5 years it reconfigures. Those are the most common ones, okay? So 5 years from now, let's say you had an arm. So 5 years from now, that 2%, it could go up to 5%. And you don't have any control over that as the borrower. The lender is the only one who has the control over how much that would go up. Now, they're restricted to a few things as they make those decisions, and that's what we're going to look at next. The index is the next one. The index is a standard fluctuating average that is the new base, that is like, I can't even read, that is the basis for the new adjusted rate. So there's a standard index, an amount that you would expect for it to go up. And they tell you this at the front. They say that the standard index was to go up is 2% or something like this. They tell you what the index would be. Margin is the additional amount added to the index by the lender. So just because the index is something, your lender might add more to it from their margin, what their margin is. The discount is the amount by which the initial rate may be less than the sum of the index and the margin. Okay, so that's like a discount. You've got a deal, right? A discount like at a discount store. There is a cap, though. There is an interest rate cap. There is an amount that is capped out at what you can increase. The periodic cap is the amount that it can increase each time it increases. Okay, so typically it's about 1% for 6 months or 2% per year. So if you have one of these arms that adjusts every year, you might see a 2% increase in your mortgage interest rate every year. That would be the idea. But then the overall cap is the amount that they're actually able to raise it over the time of the entire loan. So if you had a 5-year arm and it adjusted every year or something like that, then while it may jump 2% the first year and 2% the next year, they can only jump 1 more percent because 5% was the total they could jump overall. Does that make sense? It's not going to do 2% per year every year of the thing. But it will cap out at 5%, and that's the typical number. And then there's a payment cap, and that's the cap on how much your actual cost to you, paying it into the account, will cost you. Like the actual numbers. Like there may be a payment cap that says it's at the very most it's going to increase, $500 a month or something like that. So there's a payment cap increase as well. Now I want to talk to you a little bit about negative amortization. Negative amortization is an increasing loan principal. There are some loans that the way that they're done and the way that they collect their monies from you and whatnot, under certain circumstances, as the months go on, you actually don't end up paying anything towards the principal. And not only that, maybe you don't even make quite the total amount of the interest payment. And what actually ends up happening is you end up owing more money on the loan than you did the month before. Okay? That'll sometimes happen in credit card situations when you don't pay things and you get fees attached to it, right? You owe more than you did the month before, regardless of whether you swiped your card anywhere. This isn't because of fees, but it's the same kind of an idea. Something has happened that causes the cost of what you owe to be more than it was the month before, even though you paid something on the property. There are some convertible features in these kinds of loans. There are some of these loans that will have a ability after a certain length of time to switch to a traditional fixed mortgage. It's a convertible feature. Usually at a designated point in time. Like for instance, it might be 5 years that you're on the adjustable rate mortgage, and then at the 5-year mark you have the ability to change to a different mortgage rate. You have an ability to get a fixed rate mortgage. So there's this kind of a convertible feature to some of them as well. And then a few of them will have a prepayment penalty. A prepayment penalty charges you money if you pay it off early. Now, doesn't that sound like a winner of an idea? There are mortgages with prepayment penalties, okay? So you just need to be careful that even if you did get an ARM, which I would not advise you to do, if there's a prepayment penalty, this is bad news. Because what that means is that if the ARM increases to a percentage that you don't like and you decide, you know what, I'm done with this, I'm going to refinance in a fixed rate mortgage with another company, there's a payment penalty because you've paid the loan off early with another loan. They're going to charge you extra money. Who's game for that? No, not a good plan. There's some other things, and I want to mention. I have a friend up in Ohio, and they got involved into a loan, and if I'm remembering the details right, they got a variable rate mortgage, and the reason that they did was because her husband was in an industry where he moved about every 3 or 4 years. So they felt very comfortable with their variable rate mortgage. It wasn't going to change too much over that time frame. Everything was going to be just fine. They've been there almost 10 years. And this is a problem because that variable rate mortgage is not paying very much down every single month on their mortgage. And you know what happened during the time frame that they were there as well? We got eaten up by this a lot too when we were in Ohio, is that the housing market did what? It crashed. And you may not know exactly what that means, but what that means in most cases is people's property values went down. Great for your taxes, right? You pay less on your taxes. Not so good if you're trying to sell your house. Yes, Mackenzie?
What exactly is property value?
Property value is what the property is worth.
Okay.
So part of it is going to be like if the home were damaged, what it would cost to rebuild. Part of it is also what somebody would pay you for the property if they were purchasing it from you.
Okay.
And so there's somebody called a county assessor who will make the determination. It's based on your square footage, the types of of home you have. Like, if do you have brick, do you have siding, do you have a shingle roof, or do you have a wood roof? Because that's more prone to, there's different issues, fire and things like that. So they use all the kinds of features like that. They typically don't take into consideration a lot of your remodels unless it's an obsessive remodel. Like if you gutted the whole kitchen and redid something, that would affect your property value. But if you switched out the refrigerator to a nicer refrigerator, that doesn't affect anything. But that's your property value, and it's determined by the county that you live in. There's an assessor that comes out and makes that call. And also part of it is based on what the lending institutions will let you borrow. So for instance, if you have a home that appraises by the lender for $100,000, your property value is going to be about $100,000, give or take a little margin. They might say, oh, it's 110. Well, you're not going to have a leg to stand on. That's pretty close. So you pay taxes on 110. So obviously my friend has some problems, right? And she's stuck in this arm that they can't get out of. They can't refinance. You want to know why they can't refinance? Because they have no equity in their home. Their home is worth less than it was before. Because their home is worth less, nobody else is willing to take them on as a risk. Because they owe, I'll make up numbers, $200,000 on it, but the home's only worth $150,000. It's a problem. Those were numbers I made up, of course, but this is what people have been facing over the last however many years. And then if you compound that with the fact that their interest may have just gone up because they have an adjustable rate interest, and if father gets laid off and now we lose part of our income, obviously we've got a grand scale problem, right? And a lot of these things, along with the fact that lending institutions were actually being required in some sense from the government to make loans to people who probably shouldn't have been getting loans. People were borrowing more money than they should have borrowed, up to 50% of their take-home pay. We talked about this last time, right? That the 25% mark is a safe estimate for you to borrow for your monthly payment. 50% not so good. People were borrowing too much. People who shouldn't have been borrowing at all were borrowing, and lending institutions were being told, in some level anyway, that they had to make some of these loans. So there's a lot of things that went into it, but part of the issue is these kinds of mortgages. You have lost control over your amount because you've given the control to the lender. You've told them, you can change my interest rate, I'm going to let you handle it. And it's just not a very safe thing to do because you don't know how that's going to play out. Any questions on this?
With
All right.
credit cards,
Yeah.
like interest, if you have Maurice's credit card,
Mm-hmm.
does Maurice's get the interest, or does that go to?
If you have a credit card, whoever your credit card is through will get the interest for that. So it's tricky though, right? Because sometimes you'll see something like like my credit union has an Allegiance. It's Allegiance Credit Union is what I use. Allegiance Visa card. So there's some agreement that has been made between the credit union, Allegiance Credit Union, and Visa, which is the company that actually issued the card. And somehow they're splitting that value because there's two people who are both managing that issue at the same time.
So they only would make money off of the interest? Is that what it is?
You mean on like the companies themselves? Yes, because everything else is just you paying back what you borrowed from them anyway. Mm-hmm. Yeah. Now, I want to make mention here at the end, you're not going to have any questions on adjustable rate mortgage. I wanted to present this to you because I'm really hoping that as you move forward that you ask good questions, because it sounds really good for somebody to tell you 2% interest rate. But if they're giving you a 2% interest rate on an ARM, that may not be the best decision and probably isn't the best decision for you. So we haven't made this mistake. We've not done anything with ARMs, I'll tell you that. We've made plenty of other mistakes in our financial for-house situation and cars and whatnot, credit cards and things. We're in a good place right now, but part of it's because we started asking the right questions. We started learning the kinds of questions we should have been asking all the way along. So my hope for you, my prayer for you really as you move forward is that you find people in your life who are succeeding financially and that you ask them questions as you make your financial decisions. Don't ask the broke people for advice on money. That is not a good plan. It's like asking fat people for advice on dieting. Right? Yes. All right. So ask the people that you trust in your life who are doing well to help you make those decisions.